What is up? This is the Working Investor. In this video, we're going to cover this new release from the SEC. It looks like a draft of Defiance coming out with 3 ETFs that are going to pay twice a week. So they're definitely trying to market with this ever increasing competitive ETF fight to who could get the lion's share of the investors. The question is the lure of 2 times a week dividends worth it? And what we can consider looking into these funds. Again, they're not out yet. This is a proposed prospectus. We're going to see when they bounce out pretty soon. So they're going to do it on their 3 ETFs. The 3 ETFs they're going to launch. Looks like they're launching. It's going to be on the 3 indices: the S&P, the Nasdaq, and the Russell. These are the tickers: QLDY for the Nasdaq, SSOY, SSOY for the S&P 500, and IJRY or IJRY for the Russell 2000. I'm not sure how they need to learn from YieldMax how to pick good, catchy ticker symbols. Again, this is a proposed prospectus, so we're going to see when everything is finalized. And nothing here is financial, legal, tax, or any sort of advice. This is purely for fun and entertainment purposes only. Please see all my disclaimers. So let's look into the what they're proposing the strategy is. They have this trademark strategy called the lightning spread trademark strategy. So if you look closely into the strategy, let's zoom in. You're going to see it's basically 2 things together. So they buy long dated, deep in the money call options. And I'm going to show you an illustration to clarify this for you. And they're going to sell put spreads or put credit spreads, 0 day to expiration, right? And basically, they're just saying it expires at the end of the day. So it's these 2 things together, which I kind of think it depends. See, they didn't specify if it's going to be in the money, at the money, or out of the money. And I'm going to show you some illustrations. And here's the big hook that's going to grab all the investors. The fund intends to pay out dividends and interest income, if any, twice weekly. Wow. So only thing we need is someone's going to be coming out with, I'm telling you, thrice weekly, and then 4 times weekly, 5, and then every single day, and then I think probably every hour, maybe every minute. Again, the frequency of payment is cool, but what matters more in my mind is how they run the strategy. What is the total return of this fund and how they're going to run it? And before we get into the strategy a little bit, and we'll do some visualization of the strategy. Let me show you the sentiment. I have a lot of investors that I speak to, and I myself am a retail investor, and I feel I have a very mixed sentiment on Defiance as a company. Certain funds I abhor, I do not like at all personally, like their WDTE or their QQQY, or some people love it, and I can't stand this. And then there are certain ones like SPYI, which, not as bad. So we have a year of data, and we're going to do a matchup. I'm going to show you the benchmark of the S&P 500. And I know you can't, it's not a great comparison because the strategies that I'm comparing these funds to vary a little bit. But I'm looking at total return, price return. So WDTE is the Defiance 0 day to expiration. In the money put, so you're already you're already starting with 2 left feet starting in your day in the market. And I think they could technically do daily, or they have the flexibility not to do daily. SPYI is their call credit spread. So that's a different strategy as well. And the SPYI is NEOS, cover call, but they don't do 0 day to expiration. So that's a different strategy. GPIX is a different strategy. I have videos comparing SPYI and GPIX. I can link that. And then I'm just comparing it to XETE. So again, these are not really comparing apples to apples. I want to be completely honest with you. There are different strategies, but I just want to show you why. What I really want to highlight is WDTE versus SPYI. Why, if you look at we have 1 year of data. So price return does matter to an extent because, number one, if you want to have an exit, right, of course, total return, I feel like, is the bottom line. But if you wanted to move out of a fund, it's easy when you're positive on price return. But if you're negative on price return, you got to eat up a little bit of a loss. And of course, cover call ETF has the whipsaw effect, right? Those are what cover call ETFs. So just comparing these funds, again, apples and oranges, the best price return, I think, is GPIX, looks like over here. But if you look at this, the WDTE, they suck the most, down 32% versus SPYI down 10%, which is a little better than XDTE. And my thoughts about Roundhill, I have a whole different story. I may have to make a video about that at a different time. Now let's go look at total return and take a look and see the story over there. So we're using the benchmark of S&P 500, total return almost 11%. That's going to be our benchmark. Anything that does worse has done worse than the benchmark. So WDTE, even with all the dividends and the price drop of 32%, you would have to almost reinvest almost your entire dividend and then pay taxes on it if it's not, like, depending on if it's ROC or whatever. And then you get 3.5%, like 3%. That's horrible, because your risk-free rate of bonds could be 4 to 5%. Come on, guys. Like, why would I waste all this time and headache just to make less than risk-free rate? That's silly. SPYI, at least, you're sort of keeping up with the S&P 500. So this is also from Defiance. So I feel like I have a mixed, sentiment about this company, because they have certain things I like better with how they run, but certain things I do not like how they run. Again, it's all about, what I really want to emphasize is it depends how they're going to run this strategy. Are they going to do in the money, at the money, or out of the money, put credit spreads? SPYI, excellent, 12.28%. They actually beat the benchmark. GPIX, very close also, kind of matching up with the benchmark, beating the benchmark. XCTE fell a little short from the benchmark, but still kind of like SPYI. That's kind of what I want to highlight. Let's start looking into the visuals, and I'm going to break down the strategy for you guys. What I like about Robinhood is they have a nice visual. So that's why I'm looking at Robinhood. Let's go do the leap options, right? So you're going to get basically some upside potential. So let's go to December 17, 2027. So what does this mean? You're going to go to buy call. So instead of buying 100 shares of SPYI, which costs, right now is trading about 590, so you need $59,000 for that. You can buy a call, let's say deep in the money. Let's look for, you see on the left where it says delta. So let's look for at least a 0.8 delta, or let's make it an even $500. So it's 0.86 delta. So I think most people argue that that's considered deep in the money. Anything above 0.7 is considered deep, So we're buying this 500 calls. So instead of paying $59,000, I would pay $152 per share times 100 shares. So 15,000. 15,000 is maybe like less than a third, because 15, 30, 45,000. So 60. Actually, it's about a quarter. You're paying about 25% of the price. And we're going to break down in two pieces. So if you look at the P&L, right? So you could see, as long as your upside is unlimited. So if whatever S&P does, however high it goes, you're going to capture all the upside, unlimited, right? But unfortunately, because right now, right, you're buying a $500 call. So if it goes below 500, you're going to be your SOL. You're pretty much in trouble. You're going to lose money. But if now your break even is 652. Why is it 652? Because you have the $500 call that you purchased, but you purchased for about $150. So you have to add $150, and that's why you come up there. The point is, they're giving you a capital efficient upside that's uncapped, which is really cool for myself and a lot of people that have a lot of capped upside with a lot of cover call ETFs. I like to have an ETF that doesn't have any capped upside. That's what I like about this, right? So it's a bullish strategy. You want to have something that you really have positive sentiment. You really want to feel like, over the next few years, the S&P is going to go up, right? Now let's look at the second component, which is the put credit spread. So you start again at the S&P 500. You go to trade options. Remember, this is 0 day to expiration. So let's go today, right? And let's go to sell a put, right? Now, here's the thing, right? Are we selling a put in the money and then buying a put out of the money? So that's how they did their other, WDTE, like in the money puts. So you need the market you need the market to go up for the day. If it stays where it's at, you're losing money. If it goes down, you're losing money. You need it to go up. If God forbid the market doesn't go up, you're in trouble. And then, resets every day, but, who knows? Some days yes, some days no. Sometimes there's two-sided action in the market, right? Let's look at another way to do it. So let's see, let's undo these things and let's do an at the money put credit spread, or slightly out of the money or at the money. So it's 590. So you're going to do sell put, that's your short put, buy put 580. And who even knows that they're going to do a dollar wide? Maybe they'll do $5, $10 wide. Who knows, right? So this is a put credit spread, but now you're already at a plus, right? And as long as the market stays where it's at, or even goes down slightly, or goes up, you're a winner. Goes up, you're a winner. Stays where it's at, you're a winner. If it goes down, you're bad. So neutral or up, you're good. Down, you're bad. So it gives you a little bit more favorability, and if you could even go back over here, you can see the delta is a 0.4 delta, right? So 60% chance you're going to win, but 40% chance you may lose. But as long as you're putting the odds in your favor, even a little bit, that makes a huge difference. And that's how they, the casinos make money. They put the odds, even if they put the odds 1% in your favor over, the rule of large numbers are you're going to win, right? Now let's undo these. Let me just undo this. Let's go to buy call, buy put. Now let's do an out of the money put credit spread. So let's go a little further out. Let's go to, most people say at least 0.3 delta. So let's go to, okay, we can go to a little bit out of the money, 0.3 delta. So sell put, buy put. So now you're not at the money. You could see it's not a big difference, but you're giving yourself a little breathing room. You're giving the S&P a chance, even if it goes down $1, you're giving yourself a little bit more room on the downside. So this way the market stays up, you're good. The market kind of bounces where it's at, it's good. If it goes down even a little bit, up to $1 or a little bit more than $1, you're still good. It has to go down further than $1 for you to lose. And now you're talking about a 0.3 delta. So you're giving yourself a 70% chance of winning. So that means 30% of the time you will lose. I mean, statistically, the rule of, the law of large numbers. But, you put in the stats, you're stacking the stats on your side. But you're going to make less premium, right? Because you're taking on less risk. And how far out of the money are we talking about? We're talking $1. Are they going to go to like a point, some people like to do a 0.18 delta, 1.6 delta or lower. This is the closest, so you do sell put, buy put. I like to do sometimes 0.16 delta. Why 0.16 delta? Because that means I have an 84% chance win rate, and the standard deviation is about 84%. So the market has to move a full standard deviation to make myself lose. It puts myself in a greater potential of win. Of course, that's just statistics. But you're giving yourself, but you see, you're instead of making $25, you're making $12, but you have more of a chance of winning. You know what I mean? It's like getting a lesser lottery win, but your chances of winning the lottery is greater. So I like personally myself, my strategies. I rather get, I don't need a home run. I rather just get singles all day, all night, and I'll win the game that way. So as you can see, I've been looking into this fund when they started talking about this months ago, and they did say they're going to come out around April, May time. I guess we're end of May, sort of June. We'll keep an eye when they launch. We'll see how they do how they run it. How deep in the money are they going to do how deep is deep in the money call? How deep, how far to expiration? How much time are they giving, giving themselves? And then we're going to figure out their put credit spreads. Is it going to be in the money, at the money, out of the money? That is key, because I want to have a high win rate and I want to have uncapped upside, which I like that part of the uncapped upside, but I also want to have a high win rate personally myself. And let's see are they going to manage it intraday as well, or are they not going to manage it intraday? I feel like that's what Roundhill, what I understand is they do. It's almost like an algorithm monkey push button. They don't really do any management. Like I saw during April, I don't notice any management like the other funds did. Anyways, let me know what you guys think about this fund. Are you guys excited about it? Do you think it's a money grab? Just, they're trying to entice us, or, the jury's out and we'll see when they come out. We'll see how they do. Anyways, I hope you guys have a wonderful trading day. This is the Working Investor over and out.